Welcome to another video of what's moving the markets. So, usually I try to refrain from talking about politics, but there have been some very interesting developments which have significant implications for the financial markets. Therefore, I feel that it's important to talk about what has happened in terms of the BRICS summit, which many of you probably followed as well, and the recent Israel Iran situation. So, the keywords that I want you to focus on is polarization in terms of the BRICS summit, that there's two broad camps which are developing globally, which is, of course, going to lead to deglobalization. And the second thing I want to talk about is the short term de escalation that we see in the Middle East that is happening. And after discussing both of those things, then I will discuss how we should position in terms of our portfolios defensively, right? So, what could be a defensive positioning? As always, this is a casual series, not investment advice. Please do your due diligence before taking your investment decisions. So, let's get started. First of all, on a positive note, there has been some de-escalation expected to now unfold in front of us, right? Why I'm saying this and what sort of proof that I have that this is what markets are expecting. So the stock market in Israel went up, the stock market in Saudi Arabia went up, and why this is happening is because once the Israeli attack on Iran was conducted, what we see is that Iran is downplaying that incident, right? Which is a positive sign because that means most likely they're not going to retaliate in a big way, which could mean that we might be having ceasefire coming back, ceasefire talks coming back on, which they are. There has been a meeting between the head of the Mossad and head of the CIA and the Qatari foreign minister. So this is very good, right? In the short term, and you can see that with the stock markets in Israel and Saudi Arabia going up. So this is good. Investors are optimistic about de-escalation. However, I kind of feel this is the calm before the storm, right? Which brings me to the second point, which is BRICS. That because of that, this seems to be just a temporary resolution, right? The underlying problem hasn't been fixed. So if you look at the bigger picture, and that can be seen in the stock market again. If you look at the S&P 500, that this week it really wasn't able to make new highs. It wasn't even able to hold its previous highs, and this is what I've been telling you, right? I mean, there is weakness in the market. And if you consider why that weakness is probably there, why we think interest rates will stay higher for longer, why inflation is going to be stubborn, and that the answer is probably because of deglobalization, right? What does that mean? What does deglobalization have to do with tariffs? So you have to see what happened in BRICS summit. So you had Putin, obviously at the center of all of that, and then next to him was the Prime Minister of India and the Premier of China, and then you've got Saudi Arabia, Iran, Egypt there. Turkey wants to get in. Brazil is obviously one of the main founding members. South Africa was there. So you've got this camp developing, and the US and Western Europe is obviously not happy about it, right? And if Trump wins, he's been quite clear about this, that anybody who wants to go for a de-dollarization or who wants to stop using the US dollar as reserves and as the primary currency to trade in, Trump is going to consider putting tariffs on them. Now, what you have to understand with tariffs is that it's not like the other party is not going to reciprocate with the tariffs. So if both countries put tariffs on each other, what ends up happening is, let's say this is USA, right? And let's say this is China. So how do tariffs play out, right? If let's say US wants to protect their own semiconductor industry, that's it. Okay, guys, you have to buy locally from Intel, right? You have to buy locally from local. You can't import from China. So you're protecting the local industry. Similarly, China will say, all right, you can't buy Tesla cars anymore. You have to buy BYD cars in terms of electric vehicles, right? So what really ends up happening is that the local consumer, maybe they could have gotten a better car, will have to go for the more expensive local option, and even if they want to go for the cheaper, better or international option, they will have to pay a higher price because there will be tariffs on it. Now, this example is not very accurate because obviously BYD has very low cost products as well. But let's say if the customer just wants to buy Tesla because they like the design, they like the features, then they will have to pay a higher price. Similarly, if Americans want to buy some Chinese product, let's say they want to buy BYD instead of Tesla, they will have to pay a higher price for it because there'll be tariffs. And what ends up happening is that the consumers in both countries end up paying higher prices, right? And that obviously then adds to the inflation. And then inflation means interest rates will stay higher, and if interest rates stay high, then obviously growth sectors take a hit, and then therefore defensive positioning becomes more important, which is something that we are seeing now. Investors are, if you see what happened in the past week, S&P has been weak, but relatively speaking, the sectors which have outperformed the S&P, even though on an absolute basis they have not done that well, but relatively they've still outperformed the S&P, and those are the defensive sectors. So you can see a defensive shift happening within the market because these geopolitical issues, they're still unresolved. I mean, it's not like we've resolved the root of the problem in terms of the Israel-Palestinian issue or in terms of the Taiwan issue. I mean, recently what we heard was that there was a chip made by the Taiwan semiconductor manufacturing company which was found in a Chinese equipment made by Huawei, right? So obviously there are sanctions on TSMC. It's not allowed to provide chips to Huawei, but it did somehow. There's a chip that came out which was in Huawei equipment, which was provided by TSMC. So these geopolitical issues are just there. They are still unresolved. You might have a temporary sort of de-escalation, and something, what I would like to tell you is, if you're interested in really deeply analyzing all of this, what you should see is, in terms of the US, how much oil does it provide to itself internally, because they have sweet crude, right? I mean, your shale is sweet crude, but how much do they actually import from Saudi Arabia and the Middle East, which is your sour crude? And you might think, why do they need to do that? I mean, if they have enough sweet crude, why do we need to import sour crude from the Middle East? The reason is because the local refineries are still primarily based on sour crude. So it will take at least maybe a couple years for the US to completely get rid of their dependency on the Middle Eastern sour crude. And until that happens, I feel the Middle Eastern conflict is not going to escalate too much, right? Because the US has a dependency, partially, but it still has a dependency on the Middle Eastern sour crude. So what I feel is that this might be a short-term resolution, but the issues are still unresolved. In the longer term, you've got the Taiwan issue, and then of course in India, you've got some things happening on its eastern border in terms of the Khalistan developments, on the western border, the western border in terms of the Khalistan development, on the eastern border in terms of your cookies and metis, which is basically related to the Seven Sisters. So there's US involvement there, there's Chinese involvement there, and all these issues are just under the surface. And this is going to most likely lead to a lot of deglobalization, lead to a lot of tariffs, which means higher prices, prolonged inflation, and therefore defensive positioning is what you should be doing. Now, what does that mean, right? I mean, how do you position yourself defensively? Very, very cliche defensive sectors are consumer staples and healthcare. So that is quite obvious. Plus, how do you hedge against inflation? So equities which um, have exposure to, let's say, commodities. And what type of commodities? Obviously gold is a double beneficiary here, because it benefits from the partial de-dollarization, and also in terms of uncertainty. So investors would like to have increased exposure to gold, but then you can obviously have exposure to copper. You can even look at energy oriented commodities, companies that have exposure to that. You could also hand pick, cherry pick your sectors within tech, right? Subsectors. And I would like you to focus on the application layer of AI, right? So companies like Microsoft and Google, and this is something we have covered in an earlier video, that this is where the real future is. It's not just the infrastructure layer, which Nvidia has done in terms of providing the chips, but now those 1000 data centers are in place. And what do you do with those data centers? You train the models, right? You're training large language models, and then you're applying that and then providing them as applications to end users. For example, chat gpt, and then Google obviously is coming up with something called computer assisted usage. So computer usage which is assisted by AI. So what that means is that there will be new applications coming up by both Microsoft and Google, which will help users use the computer, in the sense that, all right, please search this for me, or please just use my computer to do such and such task. So there's a lot of developments that are happening in terms of the application of AI, and companies which are very well positioned to take advantage of that are both Microsoft and Google. With upcoming results, you should definitely keep an eye out for these two companies' results. But apart from that, overall, I think the growth sectors are definitely going to stay under pressure. Your cyclicals like consumer discretionary will definitely stay under pressure, and with higher rates staying for longer, these type of growth oriented stocks will continue to stay under pressure, while your banks, which obviously benefit from the higher rates, will continue to have higher profits. So that is also an interesting sector. Now, what else could you do? So we talked about Microsoft, we talked about Google. Obviously healthcare is something that goes without saying, which is stable in downturns. So companies like Johnson & Johnson, Pfizer, or there are many other good options you can search for. Within commodities, in addition to gold mining stocks like Barrick Gold and Newmont Mining, so GOLD is Barrick Gold, Newmont is NEM. You could also look at diversified metals through Rio Tinto. You could get into energy through something like Chevron. You could even have more focused exposure to lithium players. There are some very interesting healthcare picks that you can have, especially for an aging population, right? So companies that make medicines for things that old people get, like Parkinson's or arthritis. Even young people get them, but like mostly older people develop these conditions. So they have the ability to pay for these medicines, and they need these medicines. And there is an aging population both in the west and the east. So you could position in these type of companies as well, to benefit from the stable demand during downturns, right? So combining commodities, and that includes gold, but also metals and also energy, and with healthcare, along with AI exposure, and that obviously is within the application layer, right? I'm not talking about the infrastructure layer anymore. I'm talking about mostly focused to the end consumer, the user, and companies which are coming up with applications for that, such as Google and Microsoft. So you could use any opportunity of a pullback to buy back in. So wait for it. You get a good opportunity to enter. You could start adding more exposure to Microsoft and Google. If there is any big move to the upside, you could maybe book some gains, and then when it comes down, and then you can add some more exposure, right? So this is something you have to do actively, and this could hedge against inflation, provide stability, as well as growth to your portfolio, right? So in conclusion, obviously we see that there is a temporary de-escalation, but there is on the bigger picture, there is a broader polarization going on. On one hand, obviously you've got your China, Russia, India, camp, and then you've got the Western Europe and US and Israel camp, and India, which was half and half, is now more and more moving towards the BRICS camp, especially because, I mean, if you're really interested in why that's happening, you should look at what's happening on the western and eastern borders of India, right? So the Seven Sisters over here, what's happening over there, and what's the US stance within that, and then in terms of the eastern border, what's happening in the Khalistani developments and in Canada, and what's the Canadian and US stance on that, and why India can be seen more and more involved with BRICS, right? I mean, the Prime Minister of India was there at the BRICS summit. So this could lead to a lot of polarization, which again could lead to tariffs and then higher inflation, which means you should consider positioning your portfolio defensively in healthcare and consumer staples. If financials is your thing, then obviously higher inflation leads to higher rates, so you could consider that. I would obviously more be interested in AI, especially on the application side with companies like Microsoft and Google, and obviously keep a lookout on central bank policies, government stimulus as always, especially with the Chinese economy. Even though it's looking weak right now, but if a huge stimulus package comes in, both fiscal and monetary, then you could really benefit on the commodities end of your exposure, which is like copper and iron and everything, which would definitely benefit a lot if Chinese stimulus comes in a big way. So I usually don't like to talk about politics, because obviously everybody has their own perspective, and I don't want to make anybody feel that if there's a disagreement. So I apologize if I've said something wrong, but my only desire here is to show you that there might be pressure in terms of tariffs, especially if Trump wins, because then those tariffs will be reciprocated by the other party, which again could mean inflation will be here for longer, and then you should defensively position yourself in terms of your portfolio. And also in terms of defensive, cash is also a very good thing to consider, right? I mean, you don't have to stay invested all the time. So even if you want to enter into Microsoft and Google, even if you want to enter into commodity players like Rio, even if you want to enter into healthcare players like Pfizer and whatever companies you choose in terms of the security selection, you don't have to enter into them right now. I mean, you could just start monitoring them, enter as they come down, book your gains as they go up, and you could do a bit of active management and keep cash as much as possible. Because if there's anything we learned from the 2020 March crash of COVID lockdowns, it was that US dollar is the one that is the only asset which went up, right? Everything else was coming down, even gold was coming down. So even though, yes, we are talking about BRICS and partial de-dollarization, the dollar still remains the king, which we will call king dollar. So yes, AI is good, yes, commodities are good, yes, healthcare is good, consumer staples is good, but what remains the king of all of this is still the king dollar. So keep as much king dollar you can in your portfolio, but you need to obviously hedge against inflation. So whenever you get a good opportunity to enter into Microsoft or Google or Rio Tinto or healthcare companies, maybe you could consider that as well, right? So as always, if you found this useful, please like, share, and subscribe, and leave your comments below. And please refrain from any kind of political discussion. The only reason I got into it is because I wanted you to position defensively as much as possible, right? Otherwise, let's refrain from any political discussions. Thank you so much, and see you next week.